good morning, good afternoon, good evening, wherever you are. Thanks for joining us. We're still waiting for just a few people to come in. And if I could ask, if you're online, if you could put your microphone to mute, please, that would be wonderful. Okay. Delighted to have you here and joining us for this exciting webinar. We're really asking some challenging questions here today around the notion and the domain of innovation. My name is Paul Mark. I'm delighted to have you here. I'm the sort of host working with our colleagues at the Stanford Center for Global and
Stanford Engineering Center.
So Stanford Engineering Center. So everybody should know that I used to work at Stanford and ran the Stanford Center for Professional Development. They've recently changed the name. And so my great colleague, Hannah McCabe, why don't you give us the actual name of the new center that you're running with lots of continuity in business. Hannah.
Absolutely. Hello, everybody, and welcome. We're super excited to have you all here today. My name's Hannah McCabe. I'm Associate Director of Custom and Executive Programs at the Stanford Engineering School Center for Global and Online Education, formerly SCPD, Stanford Center for Professional Development. So we're super excited to have you. I run the program, the Stanford portion of the Luminarian Fellowship, and I'll be here throughout this webinar to answer questions about the program, specifically at Stanford. But with that, I'm going to go ahead and pass it to Paul, who I've known for some time, and we're super happy to have him with us today.
Thanks, Hannah. And we'll talk a little bit about the Luminarian Fellowship and the why we're here in a little bit, but I want to sort of get right to the action. I have the privilege of introducing a very good friend. While I was at Stanford, Professor Mike Lepech and I worked on a number of different international programs, ranging from our work in Thailand, where we did not only sort of professional executive education, but research. He's a faculty member in civil environmental engineering and now part of the Dorr School of Sustainability. He brings both the scientific perspective as an expert in cement, as well as an MBA. So he's done almost a sort of jack of all trades and master of all of them as well. Really incredible individual. He is directing the portion of our Luminarian Fellowship that will be conducted with our colleagues at Stanford. He's joined today by Jeff Wong. Jeff is an innovator, entrepreneur, and most recently just exited EY as their global head of innovation. His perspective in and around innovation, he's had an incredibly sort of saturated perspective in corporate. He's also really focused on the sort of why this happens, why companies struggle, why they succeed. And we'll be hearing from both Mike on the research side, some perspective that he brings globally, and Jeff sort of on the more tactical, practical side. We know that there'll be some amazing lessons to take away. Mike, I hand it over to you to lead the charge.
All right. Thanks, Paul. Great to see you, Jeff. Thanks for joining us today.
Happy to be here. It's a great day in California, so
it is.
Happy to be on.
You know, it's finally warming up a little bit in the Bay Area. The rain is on the way, but we certainly need it. And yes, it's a great morning. I want to just let everyone know on the call this morning that Jeff and I would be happy to comment on any questions that you all put in. Feel free in the chat for the Zoom meeting to put whatever questions or thoughts you might have, and I'll be sure to kind of keep an eye on those so that we can address as many of them as we can, recognizing that we also have a lot of other things we want to share. For those that are online, if you haven't already done so, please mute yourself so that we can keep the audio channel pretty clear. And so, Jeff, you know, I want to start off a little bit with some of your background and sort of how you got into innovation and leading an innovation organizations, and then we'll sort of dive into some of the more interesting questions that we also have to talk about.
Mike, first of all, Stanford, very near and dear to my heart. Just for the audience, I went there for undergrad, 2 graduate degrees, and then I teach a class every year back on campus. So it's as closest thing to home as I have, other than really being in my home where I am right now. So Mike, I got into this field of thinking about how companies evolve really from a practice perspective. What was interesting was I worked in venture capital, I work in tech growth equity investing, and then I joined eBay and I spent almost 10 years there doing first strategy and ventures work, which was the strategy part, I think is fairly clear. We were a relatively large company. How do we think about being bigger? But the ventures part was recognizing that we couldn't just do what we had been doing. We had to be doing new things. And that led to me forming a whole new team there called the Business Incubation Group. And it was the idea that we need to be able to not just build things against our core business or buy things, which we were very good at, but we need to be able to build from the ground up as well. And that's really where the most fun parts of sort of my innovation journey started. It was the idea of invention, the idea of creating new, entering markets that didn't exist in that form before, delivering new products to a community that you could see the need but didn't have a solution for it. So after that, I got recruited to go join EY, as Paul referred to. So there I was the Global Chief Innovation Officer for 9 years. So I spent a long stretch there. Two types of invention. One was building the team itself. So when I first joined, it was literally just me. And our budget was something like $2-3 million in that first year. By my 9th year, our investment budget alone was over $100 million. And we had done that for several years. And we don't go through the specific numbers, but it was large. So it was $100 million at the global level, a couple $100 million at the regional level. And we are investing this every year in a systematized process of innovation, not just an ad hoc, there's some fun experiments to do.
Yeah.
So that's been sort of the last 2 decades of my life, putting the idea of innovation into practice.
Yeah, no, that's super cool. You know, my journey to this topic is a little bit different, but within the academic viewpoint, you know, coming from the field of building and construction, everything that we do in our discipline is a one-off. Everything is from 0 to 1, and we never get to do it again, right? We never scale anything because every single project we do is unique and different and bespoke. And so therefore, you know, we have developed a lot of frameworks, tools, and approaches for continuous improvement in organizations and workflows where you are literally doing something innovative with every single project, because none of them are a carbon copy of another. And so, you know, my journey to sort of innovation organizations and innovation thinking looks to leverage a lot of the long-standing research that we've done in how do you go from 0 to 1 again and again and again and again, while, you know, kind of driving forward best practices and continuous learning. And so, you know, I have found it to be a really interesting application of what you would think would be applicable to, yes, construction of the built environment, but to the way that large organizations over time need to continue to go from 0 to 1, to get those ideas out into the company and then finally in the hands of customers. And so, yeah, I think this is going to be a fascinating conversation with a lot of interesting practical viewpoints and some really cool frameworks that will also be a great intro to what I think is going to be an exciting program as the Luminarian Fellowship. So, you know, I wanted to start off with a little bit of a discussion on organizational innovation. And like, what does that mean, right? Because we talk about innovation from a product standpoint, technology, all this other stuff, right? Organizational innovation, what does that mean to you? And what do you think there is to be learned here?
Well, Mike, it's really interesting. I sort of, we grew up, we are both in Silicon Valley now. We both grew up here. And the idea of innovation really, if you walk around the valley, is really much more about the new startup, right? The separate from large organization, we're starting a whole new company, the venture capital ecosystem, and all those things. And I always had a slightly different thesis around innovation overall. And that is that large organizations have the brains, the access to capital, the relationships that they need in order to be successful in inventing new things and entering new markets. And what we continued to start to see was, well, why does the young company beat the old company? Why does this always happen? Or seem to happen a lot anecdotally. And what I thought was like, this is silly, right? When I worked at an eBay or an EY, the reach, the scale, the brand, the capital that we had access to should mean that we should be able to win entering new markets. We should be able to beat the startups and things, the younger companies.
David and Goliath is a great story, but normally Goliath wins and should, right?
And that's, to me, why organizations need to think about their world differently. What I saw was large, successful organizations were really focused on running their companies in a way that was successful before, right? Successful in a time frame where you had a lot of time to figure out that new market entrant. Let me think about it. Maybe I think about acquiring young, but why would I do that? Let them establish themselves in the marketplace, and I'll come in later. Right? I'll just be later to the game. It's fine. I have the time. And what we've seen with the time cycles of change compressing is that large organizations now need to think about this differently. And so when I think about organizational innovation, it's not about any specific market, any specific product, any specific toy that you build. I call them toys. Everything I build, I call them toys that you build. It's about the process by which you continuously do this, right? So an organization can't just think, I'm just going to do the brilliant one-off. They have to think about, what's my systematic process for continuously being able to adapt to new technologies, enter new markets, change my product to address the new customer expectations, because those are changing much faster than before.
You know, as you're talking about this, I'm thinking about our framework for product market fit. And just so that everybody knows on the call, I am a real big proponent of like framework-based teaching, right? And that's something we try to drive into all of our programs at Stanford, because I don't know exactly what problems our participants and our learners will have. And they are going to be complex, and they are going to be endlessly changing. And so I can't give you the answer to your specific problem, but we can teach you the ways to structure your thinking in ways that you can be an amazing leader for your team, so that you can get them to the right solution. And so if I think about our framework for product market fit, it's a Venn diagram of 3 circles that talks about customer need and market need. And then talks about the products that you can that you have for that market, but then also your capabilities as an organization to actually deliver those products and access those customers. And only when those 3 things come together, it's not just product and market fit. You also have to have your own capabilities in there. And you know, and we like to say that, you know, a startup is an experiment in product market fit. That's all it is, an ongoing, you know, attempt to get product market fit. And they're always going to be more successful and faster at getting it, because they don't have to worry about the large execution capability investments that have been made over years, if not decades, and in some cases centuries, that have to be moved as shifting market demands change as well. And so sort of, as you said, the process-based thinking of how to do that, how to make sure your organization is ready to continue to stay on that product market fit Venn diagram union is both challenging, but incredibly important. And that's so much of what, I think that we also think about when we think about organizational innovation, and how do you prepare your organization, not for just the specific technology or toy, as you say, but rather being ready to respond to anything that market says, yes, we're moving in this way, and this is the way we're going to do that.
Yeah, Mike, I couldn't agree with the framework more. And to put that framework into how big companies could think about it, that capability set for a large company is much, much bigger than for the little young startup ones. I think that one of the challenges, and if there are questions we could go down this pathway, is about culture and acceptance and senior leadership and all those things. Because while your capability set is much larger, sometimes they feel like they're baked in concrete or baked in concrete, meaning you can't change them for the moment. And so it's the ability to think about, for large organizations, how do you take the capabilities that you want, and how do you leave behind some of the historical weight or the sacred cows from history that allow you to break through and say, no, 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 we can use the things that are positive and leave behind some of the things that won't help us address this particular product market fit. And that's sort of the magic of why large companies could be so much more successful at this consistently around the world than perhaps the stories tell us they are.
Yeah. Well, and I think that's a great next segue into thinking about key issues that you think organizations are facing today, and why are they facing them? And I think you had mentioned a couple already, right? Like, you've got this large asset base in place, you got competitive advantage that you have worked to build up over many years. And you have issues of culture, you have crazy competition coming in left and right. What do you think are the big things that large organizations that are trying to innovate are facing today?
Mike, I could talk about this the whole time, but I'll go with one to start. Maybe we'll get time for two. One is clearly the pace of change, and I know it's almost a trite expression at this point to talk about that, the acceleration of the pace of change. So we can go through, if you go back through history.
It's not trite, Jeff, because something like DeepSeek just upended everything overnight, and so it's like, yeah, wow.
Yes, and if you go, and I like to look at, Mike, since we work together, I look back through history, right? If you go all the way back to, mainframes, to client servers, to PCs, to like, if you go through that and you just map out this time, the time between these large architectural shifts, right, throughout history, and then you realize on top of that, the new product that can be delivered, and you can list out at every stage. Oh, it was operating systems, then it was application software, then it was mobile devices. So now I can do music on the fly, right? You can see why the architectural changes underneath lead to new products for customers and new expectations for those customers. And you can just watch on, we have this on a timeline. So, if you're part of our program, you'll be able to see it. You see this thing getting tighter and tighter. And Mike, to your point, AI has been around for decades and decades, 60, 70 years.
It's called like expert learning and machine learning, and it had other names. It's statistics.
Yeah, so statistics. Yeah, exactly. It had lots of different names. Machine learning, deep learning from 2013, 12, 13-ish, sort of the practical application. And we all said, this is amazing. To 2 years ago, you had OpenAI LLM approaches, and then last week, 2 weeks, we had DeepSeek. Right? So you see this acceleration in these platform approach changes. So if you layer on top of that what I said about companies, the challenge is that a lot of what we've been taught, and Mike and I both went to business school, maybe a lot of you on this call went to business school, and I don't mean to throw us on the bus, but I did go to Stanford Business School. And a lot of what they teach you is about how organizations were successful historically. But historically means these really great case studies you get from the 1980s and the 1990s, which was an entirely different context. In the 1980s and 1990s, or 70s and 80s in particular, you had a lot of time to think through how the world was changing. So you could do these multi-year plans, annual strategy meetings. I mean, I was a part of a lot of them. Annual strategy meetings, annual planning, things like that. That all applied wonderfully well in the 70s, 80s to structure sort of what was going on then. It doesn't work today. And I think that that's sort of the observation of why this topic is so interesting. With the world moving so quickly, all the infrastructure that organizations have put in place to protect competitive advantage, five forces, SWOT analysis, all great tools. I'm not taking away from all great tools, but the slowness of how that reacts to the world isn't applicable today. And that's why organizations, I think, struggle right now with the pace of change. It's because you have to be able to adopt and react in a time frame that is just far shorter than before. And decision-making processes, organization structures, and none of that is actually set up to address the speed at which the world is changing.
Yeah, one of the things that sitting here in Silicon Valley that we've been able to think deeply about, and I know that you have exposure to this as well, is trying to learn from the venture capital community about what kind of tools and what kind of organizational structures can be leveraged to be able to manage an innovation portfolio, right? I mean, functionally, this is what venture capital does, right? Construct a portfolio of highly innovative teams. Okay, in this case, they're separate startups, but you're managing a portfolio. You're supporting those initiatives with yes, money, but a lot of folks don't realize the most important role of the venture capitalist is to provide help, contacts, services, anything you can, because you're highly incentivized for that team to be really successful, because you only make money once they get IPO'd or M&A'd or whatever else it is. And so, I want to kind of parlay this into a question that Dimitri sent in online regarding intrapreneurship. And this idea of intrapreneurship inside big companies and corporations today. How can management support internal startups, innovations, and teams? And from my viewpoint, we have done a lot of work trying to understand the differences between entrepreneurship and intrapreneurship. In one of my roles as faculty director of the Engineering Entrepreneurship Center, STVP, this is something that we're really passionate about trying to understand, is how do we take the lessons of entrepreneurship, venture capital, and sort of the secret sauce of Silicon Valley to go from idea to huge company. How do we get companies to be able to internalize some of those things? And one of the really important pieces is, number one, a mindset, and we'll talk about mindset in a little bit. But number two, those tools that VCs have for thinking about managing that portfolio in a really important way. And you do not manage it like traditional Mankiewicz portfolio theory, like a big PE investment. It's a very different approach. But with the right AI supported tool sets and the right kinds of software that is specifically developed for that community, we think that there's tremendous opportunity for large organizations to adopt an intrapreneurship model with a couple of really important tweaks. I'm wondering what you saw in your time at EY on how that might apply, given that you had one foot in the VC world previously, and then thinking about innovation internally.
Like it's a nice parallel to the journey I had at EY. When we started, as I said, it was just me and a couple $1 million, and we'd run around and do these fun experiments. And that was sort of taking the full, just being an entrepreneur, right? Just sort of, let's just be an entrepreneur, but let's do it in the context of this large organization. And what we realized was we did very, very well, right? If you can take advantage of the capabilities at any company of the group that's here, any company you work with, any company you're at, take advantage of the best of the capabilities and assets and leave behind some of the stickiness, you will be successful. The math is so much better for you than being an independent entrepreneur. It is incredibly better. So we were successful. And as I like to say, we cheated, but we cheated in the right way, which is we just said, great, there's all this knowledge, in our case, all this data, all these people that could sell for us, that we could take advantage of that. And then what we realized was that your impact is fantastic, but still limited. We were a $30 billion company at the time, going to 50 ultimately when I left. And so, the number as big as you could make it, 500 million in the first few years, we were $1 billion to $2 billion recurring revenue, the impact. It was great, but how do you even scale that, right? Because how do you make that even bigger? In the way that companies need to think about that today is what you said, Mike. It's this venture capital process. So we had an investment committee, a portfolio, external experts, experiments happening all over the world, the understanding that not every experiment works, right? And that's okay. Metrics that weren't the same as the corporate metrics that were specific to a portfolio that looked like this. And I think the interesting thing is, having worked in venture capital before, I think a lot of people from outside, when they come visit, they think it's magic. Like, these venture capitalists, they just know something that no one else does, and it's this brilliance. They're just genius people. They're smart, right? Like, I don't want to take away.
I teach venture capital at Stanford. I can tell you, it's a process. Yes, they're smart. You're right, but like, it's a process, and venture capital is asset management. It isn't about building companies.
Exactly, and that you can build up a portfolio approach appropriate to this entrepreneurship, to link it to the question. And so that it's not just a bunch of entrepreneurs that are, out in the world just trying to do well, not protected inside of the company environment, not given the resources, et cetera, fighting for every step along the way, but you create a process and a system that allows you to protect them, to make sure their careers are still advancing, they're getting the promotions they still deserve to need, even though they're working on things that are more experimental and not the tradition of the firm overall. And all of that is not a magical thing, but a systemized way of thinking about the world and putting in these systems and processes to be able to invent all these cool new things. And I think that was one of the grand insights, I think, over the 20 years that I've been doing this is, wait, hold on a second. This isn't just, let's hire the singular genius model. Like, if we just hire enough singular geniuses, we'll be fine. They'll invent the new thing. It's no, we can do this systematically. And that system can even be passed on to the next generation, so that it exists more like a function inside of a company.
Yeah. So Jeff, you talked about having a couple of different metrics that were different than the organizations as a whole. Can you give me an example of one that you found to be useful in the innovation sort of unit that would have been different?
So I'll start with what was the same, right? So we never wanted to do innovation for show, right? It's or this sort of, let's have fun with this and it's just fun, because I think there's too many people who perceive this as just entertainment. Oh, it'll be entertaining. The fact is, if you're doing this, particularly in the context of a large company, but frankly, if you're a startup on your own, you're doing it to make revenues and profits in the end. Full stop, right? Like, at some point, this has to be a viable entity and a growing entity and growing faster than your other businesses, right? Because if it doesn't, then why'd you do it? You could invest in the older businesses and make them grow. So in the end, it's revenues and profits. The difference is just not necessarily this year, right? So we're not on a quarterly system or an annual system. We know that over time that we have to be able to generate these things, and we do measure that. So you have this patience associated with it. But each of our metrics underneath that were more custom. And the ones I liked were, if there's an early stage experiment project that you're building, right? Revenues and profits are probably not the right metric, right? Very, very likely. It's just traction. So it might just be something as simple as the number of target customers that you've signed up.
Yeah.
Have you signed up 5? Okay, if you've signed up 5, can you sign up 15? If you can sign up 15, can you sign up 100? Because inside of that, you might be exploring, what is our business model? How much is it really worth? And all those questions. So you set aside revenues and profits, knowing it has to come, and you just look at pure traction metrics. How many did I sell? even earlier than that might be, did I deliver the first or second module, and how did the beta customers, the alpha customers react to that? Did they want more, or they want us to stop?
And it goes back to, once again, that sort of venture capital thinking. No venture capitalist says, how much profit did you make this quarter to a startup in their portfolio? And yes, that is a different mindset. It is a longer term of thinking. And so I love the idea of bringing some metrics from sort of the milestone based venture capital investing approach into this. You know, Ozan asks a question around convincing top management to start allowing or supporting entrepreneurship. And this actually, you know, builds upon a point that you just made. Like, look, ultimately, this is a business, and businesses have to make money. And doing this as a series of bets that always lose is never going to work long term. So, you know, how do you think about, in your opinion, balancing innovation strategy against revenue goals and all of the other things that a large organization needs to do? And if I can sort of extend that, I think that if you do that well, senior leadership and top management will pay attention, because they also need to report to the board of directors, hey, what is our innovation strategy? How is it going to contribute to our overall profitability? When is it going to hit the bottom line? How do you think about balancing some of those things and then making that case to top leadership?
Well, what's really interesting, I think, is first you need to find a way to get buy-in to make it systematic. You need buy-in at the C-suite layer, and in particular, if I were to be so blunt, the CEO, chairman, or chairperson, right? They really are the ones who are the holders of the long-term future of the firm. So in some organizations, it could be president or COO or things like that. There's a couple other titles, but you know, the concept of who holds the 5, 10, 15 years, the sort of legacy of this firm. Because if your sponsorship is at a quarterly report, C-suite, right? There are plenty of C-suite that are quarterly, you know, judged on a quarter. Business unit owners, et cetera, et cetera. The unfortunate thing is, in their portfolio, when things get good, they're willing to make these investments. When things get tight, they need to scale back, right, to make their quarterly, annual numbers. So you really need to be at that executive layer. And then I think at that executive layer, because they're tending the sort of the tenure idea of this firm, that exists beyond even their tenure, I think they are very open to the conversation around two things. One is revenues and profits that come to them over that time frame, particularly if it could be very large, right? Because they're looking at is, how do I add in another line of business that can grow faster than my current portfolio and someday can replace my current portfolio? They understand the mathematics associated with stock price going to that point. The second thing is strategic. And that goes back to these architecture changes. What they start to see is, oh my goodness, I have this great existing business, this widget that I'm building. But now we have DeepSeek or OpenAI's latest version. And what I see at a high level is my customers are now telling me that they've got a different way to do this, a different way to answer this question or the problem, whatever that widget that you're solving. But the entire organization that they've built to deliver that first widget is built to protect the widget and protect the current way the widget is done. And it's not their fault, right? It's not their fault. This is everything.
That's the way the incentives were aligned.
This is everything the business schools taught them in the 60s, 70s, 80s, and 90s, and early 2000s was create a widget and then protect it. Protect it with lawyers, protect it with processes, build it into your supply chains, like do everything you can to protect it. And there's wonderful ideas around that because that's the cash cow. But what happens when some underlying things change? It is hard to break through all the protections you have around that widget. So the second thing the CEO sees is, yeah, I have a whole team building these widgets, wonderful widgets, cash cow widgets, and they've protected these things in 80 layers of padding. But the context has changed. And it tends to be the CEO or chairperson who has that mindset and whose job it is to step back and see that. And I find those two arguments work really well. Number one, you're going to need a new line of business within 5-6 years to frankly grow the business faster than expectation. And secondly, your current businesses are under threat. And in today's world, with the onset of AI, and if I may be so bold, the renaissance of Web3 and the context, particularly for financial systems that are being built right now, which I know aren't as in the press as the AI theme, those two contexts and others that are coming, which we can talk about, but are coming, means that the world is changing for every existing leading business in every category.
Yeah.
And I think CEOs see that.
One of the things that I like to do, and we try to do in all of our programs, is also relate many of these things back to the fundamentals of economics and sort of really, really core practices. And you talked about, we're going to build the widget, we're going to protect the widget, and then when the underlying framework changes, that becomes problematic. This is simply a grand illustration of the sunk cost fallacy, right? In that you say, look, we've spent all this money, we've made these huge investments, we have to continue to invest in this because this is what we've always done, or we have been doing late. And that is the classic sunk cost fallacy of, you should not base future decisions on past actions. It has to be based going forward. And so I love it when we can bring in these very classic economic and behavioral, sort of, concepts, which are, tried and true. We know these things apply to this really exciting space. As we talk about some of the revenue goals and things like this, once again, pulling from Silicon Valley in the venture capital space, venture capitalists have a boss as well, right? Limited partners want to see returns, right? Much like boards of directors and shareholders want to see returns. And so it's not as though, they don't have anybody to be responsible for. They have hard targets to meet. And the way in which they levelize and generate those returns is through a portfolio, right? Just like any kind of investment, where if you are going to make individual bets, you're basically gambling and hoping that something will win. That is not the way that innovation in Silicon Valley is manufactured, right? As I like to tell my students, hope is not a strategy. Portfolio theory, as it's constructed to be able to make very specific bets across a range of investments, is the way that you levelize returns and try to get that kind of future proofing of your innovation strategy, in order to make sure that, we always have something in the pipeline. And it's not 5 investments. A typical venture capital fund will have dozens of investments in order to spread that very high risk of any individual investment out, so that you always have something that you can report back on. And that's where I think that the application of some of the concepts that might not be obvious to folks that are used throughout Silicon Valley and have been used since the 1960s can really be leveraged in new ways within organizations.
Oh, Mike, you're absolutely right. It sort of goes against the movie version of Silicon Valley, right? We love the movie or the popular book version of singular genius, figure something out, and then they create one of the largest companies in the world. And I think that while it's a more fun story to tell, the fact is those existed within the context of a portfolio, right? They bet a lot of different. Google, when Google was formed and created, there were easily a dozen other search companies, but we tell the story of Google. eBay, where I worked, there were more than dozens of e-commerce company. eBay worked, right? And there was some technological in the background why it worked, capture the imagination why it worked.
History is written by the victors.
Yes, exactly. So now we tell this story as look at how genius these geniuses were. And yes, they were great and they are geniuses, et cetera, et cetera. But they existed out of a big group of things.
Yeah.
And so that's the context of venture capital. It's like, wait, great. If I bet on, or if I invest in a portfolio of these, I am going to win over time.
Yeah.
Right. So how do you create a great portfolio? How do you have processes around that? How do you allow yourself to still take the risk and have the imagination, but recognize in that imagination and set of risks that it sums up as a group to a nice big outcome? And I think that's the system that needs to be created.
In our last couple minutes here, I want to get to one other question that's coming in the chat, and then we'll have a final comment before turning it back to Paul. Cirrus asks a question around like inherent challenges and antibodies kind of trying to kill innovation inside large organizations. Is the ultimate solution, Cirrus asks, breaking these up? Just break up the large organization? And maybe if I can put another spin on it, is it spinning out and saying, look, it's not possible to do innovation internally. You have to do it external. And that's really the only way that it can make that it can work. What do you think the solution is here?
So, Mike, it's interesting because in both eBay and EY, one did break apart its large businesses, and the other one very publicly tried to break apart its large businesses. Part of the context for each one, by the way, was because the world's changing really quickly, and we need to allow ourselves more freedom in the experimentation around these businesses, these large businesses. But no, I'd say you can do innovation very successfully inside the context of large organizations. So when I left, I think we did the last year we did $6.70 of revenue, recurring revenue, for every dollar we had invested in the previous 12 months for that portfolio.
Yeah.
Think about it. That's not, I'm bragging about my team now. That is $6.70 of recurring revenue, not a multiple on it, recurring revenue for every dollar we invested. Why? Because like I go back to the very beginning, we cheated. We had a $50 billion company underlying our investments. We could talk to any customer in the world. We knew our market study was the fact that we talked to people who were on the ground with the problem itself, right? Yeah. Which were directly involved in that invention of what solution would they buy, our people and the people on the ground. Even with that $6.70 inside that portfolio, we were able to invest a significant percentage of the portfolio on things that just generated margin. Us doing faster, our current process fast, that we don't even account for that because it was just, time is harder to account for us. So $6. So does it work? Yeah, mathematically, it's incredible. And it sort of was the proof of the thesis I said at the beginning. Large companies can do great, amazing inventions and do it actually bigger at a far greater pace and far more successfully because of the advantages that they come with.
Yeah, totally. So I actually think that points a little bit to Zamir's question, asking about, X returns, VC compared to entrepreneurship, and how in some regards, the metrics need to be different. Like ARR was much more important than an X on return because you're not going to sell this thing, right? And so therefore, I think that's a really interesting sort of reframing of what success means to a venture capitalist versus what success needs to mean to an internal organization. All right, so Jeff, here's what I'm going to propose. We're going to come back to the two of us with our final recommendation for everybody on the call that when they go off of this webinar, what would be the one thing you want them to remember? One sentence that they should go away with. We'll give you some time to think about it. I'll think about it as well. I'm going to turn it back to Paul to talk a little bit more about the program, the kinds of things we're going to be talking about in the broader program, and then we'll come back with the last thoughts from Jeff and I on what you should do today or tomorrow following this program.
Thanks, Mike, so much. And Jeff, wow. I mean, you can tell if you're in the audience, this conversation is both rich and can go on for quite a while. So thank you both for really delivering on the promise of this. So why should we double down on our sort of innovation investments? My job is to share just a few words about the Luminarian Fellowship. We're delighted to have Jeff as an advisory council member. So you'll be seeing more of him if you're able to join us in this program. It's an invitation-only offer, and Mike Lepech is academic director of the Stanford component of the offer as well. So we've got some world-class talent joining us to make sure that we both have the rigor and the frameworks that Stanford brings, along with these sort of, I'll call it gray-haired experiences some of us have. A couple of reflections that I had and things that we'll be embedding in the Luminarian Fellowship. First, innovation is a process and a discipline. It's no longer the domain of the sort of Steve Jobs and the Edisons and the Bill Gateses of the world. Those are incredible individuals who happen to combine lots of skills. But some of the research at Stanford starts to indicate the process necessary in order to affect change. And a colleague of mine, Saeed, who's on the call here, mentioned this the other night. We're trying to think about innovation just like sales and marketing and sort of a product management process. These processes can be repeatable, and in each company, it's going to be a little different. I love, Jeff, your notion around the car. And business schools look in the rearview mirror to see what's happened and try to help you predict the future. But if you're driving a car and you're looking in the rearview mirror all the time, you're going to die. So what we don't presuppose to have all the answers. I think one of the exciting parts is we want to start looking through the front windshield to sort of explore the landscape, to understand, if you join our program, to understand and help you understand what that future will look like in your organization. So there are a couple of things that we're offering. First, 4 amazing global summits where we'll have folks like Jeff and others join us and get excited about and share their lessons and frameworks. The second thing is we're going to be offering an incredible community. It's an invitation-only program. We're focused on trying to think about convening the best and brightest who are both struggling with some of these ideas, but also can contribute to this community. And then finally, this lifetime membership, if you're able to join, we want you to bring back these ideas and concepts so that we can start to really create an impact, so that innovation becomes just like sales and marketing, a repeatable activity inside organizations that will sustain companies, that will allow them to move faster and quicker in the face of AI or whatever technology disruption is coming, so that we can preserve jobs and we can create a better, more prosperous future for all of us, for those companies that we serve, for those organizations in which we have invested time and effort. So I'm going to stop there. We're excited. If you have questions about the program, we'd be delighted to answer those. But I'm going to turn it back over. I see a few more questions in the chat, and I'll let Mike and Jeff take us from there. Hannah, did you have anything else to add before I hand it over to our esteemed speakers?
No, I just want to add that the first summit is at Stanford, and we are very excited for those of you who do end up joining us. You will meet all of us in person, and I hope to see all of your shining faces there.
Mike and Jeff, back to you.
All right, thanks, Paul. Zohib actually put in a question here from a fellow E-Wire. So what are your thoughts on the metaverse, Jeff? And more generally, how do you think about navigating hype versus value?
Yeah, Mike. Well, glad to see a fellow EYer on the call. That's fantastic. Great firm for everybody. So things like the metaverse, right? There are a lot of different concepts that come and then don't quite hit the value creation that was talked about in the press or amongst the pundits, et cetera, et cetera. And this is why the portfolio is so important. When I was at EY, we did have a metaverse center of excellence. But what we did was we just scaled that investment to make sure it matched the traction that we were seeing, right? So it was a very small part of the portfolio. It stayed a small part of the portfolio, but it did not also go away, because it's important to understand that these technologies do have promise. They just might not be here right now yet. Another interesting story, not specifically about the metaverse, but if I reach back a little bit to the early days of blockchain, Bitcoin, and if you were at EY when Mark Weinberger was the CEO and chairman, so that was a little while ago, probably if you reach back 6 or 7 years ago, we were starting the blockchain practice 10 years ago at this point. And this was when Bitcoin was just coming on, and it was very, very, very early.
That's when you bought all your Bitcoin, right, Jeff?
Exactly. That's when I bought all my Bitcoin. Anyway, so there is a fun story about ETH that I will tell if at that first week. The Ethereum founders, no less. So what Mark came to us, and we were investing at that point just a couple $1 million. This is maybe year 2 or 3, in the idea of blockchain broadly, blockchain, crypto, Web3, before it was called Web3. And he said, he knew we were just investing a very, very small amount of money, very, very small team, one partner, tiny team. We were just seeing how the market developed. He came and offered us 10x that investment. So in the tens of millions of dollars. He's like, okay, I think this is big. I'm going to offer you in the tens of millions of dollars. I don't want to be too specific, but it was tens of millions of dollars to invest in this space. And the head of blockchain and I got together and said, what do we want to do? He says, well, we'll take another $1 million and we'll give the rest back. It's not about going big with the hype. It's about the hype curve versus the reality curve. And what we wanted to follow, and this is the discipline I really I felt very strongly that we were good at, was following traction, reality, not following the press and what it was saying. So we invested at the reality curve, although you might have seen, I and certainly some members of our team, we talk about it, the hype curve, because we want to be in all the different conversations. And that was important for us to hear what everyone was doing around the world and to be a part of it. But we saw the reality curve. Same thing with metaverse, same thing with other technologies, early AI, quantum AI. Actually, reality and hype curve were actually very closely aligned. Quantum hype might be below what reality is, right? And it's our real understanding of how that works. That is the magic of large companies. With the reach that we had, with the reach that all of you have at the large companies that you exist at, you can see what is real and what is sort of the media liking to talk about things. The difference between that is the advantage.
One of the things that you also mentioned in this was you can sort of manage hype versus reality and value proposition through that portfolio, right? When I think about our frameworks for innovation inside large firms with new technologies, I think about 3 different ways that you can view sort of your pathways. One of them is to fortify your core, and to say, look, we'll use this technology to really fortify our core products, and we're gonna bake it in, and we're gonna use it as part of that fortification of our core. One of them is to sort of innovate into adjacencies, where you're identifying synergistic value opportunities, additional value propositions that are not your core products, but build off of those core products. And then the third is completely new business lines and units and stuff you've never done before. And there you can kind of toggle that incorporation of reality versus hype to say, yeah, maybe you're a little bit closer to the hype curve on the new business. When you're talking about fortifying your core, like, it's got to work, because it's really important that you maintain the trust of those customers. And so you don't have as much room to experiment. And so that way, with a portfolio that really can accommodate all three of those pathways and strategies, you have an opportunity. Not with a single investment, but with that portfolio.
We definitely, Mike, followed that, right? They call it the 70-20-10, whatever the right percentages are, depending on industry and company. But we definitely followed that that mindset, and hopefully that sort of demystifies. Well, maybe this group on this call already had it demystified, but as you are able to communicate and teach this to your organizations, to your CEOs, to your C-suites, it demystifies this whole process. Which outside in, a lot of people, I've had a lot of conversations. It's just magic, right? Like you just come up with an idea and then it works. And it's not magic. It's a systematized process that will work over time.
Yeah, totally. I love the illustration that we also did. I come with a lot of frameworks, a lot of things that we've seen proven out, and you come with amazing experience. And this is just an example of the entire programs that we run, bringing in lots of amazing practitioners with great grounded theory for you to then move forward with. All right, as promised, we got to give our two little bitty short recommendations on how people should go forward. My recommendation, you stole it a little bit, was process. Right? You moving forward, you want to think about what is your process going to be for investment decision making internally, for where your investments are going to go. How are you going to construct that portfolio? At every venture capital firm, there is a lot of process. Are there a few, sort of larger bets that you're making for other reasons? Absolutely. But they are the exception, not the norm. It is a very process-based investing practice. And so therefore, my advice to everyone on this call to sort of move forward is process, systemization, and seeing how you can manufacture innovation going forward. And that process has to be documented. It has to be really, like I said, made very systematic in every single aspect. So that would be my advice for folks going forward they can take away. Jeff, what would you tell folks they need to think about?
I'm going to cheat. I'm going to say two different things. One is to remind everyone, Goliath is supposed to win. Right? It's the mindset that you aren't supposed to give ground to the startup or the venture capitalist. You are supposed to win, right? And it's full stop. And we can go through all the stories, the math of it, and where we win. And you are supposed to, in the industry that you serve, you are supposed to win. Full stop. You not winning is on you, right? And I think that's sort of the realization that the CEO, our board, I helped them come to, is like, we're supposed to win every time. Like, this is not we give up the game. So that's one big theme. The second is more personal to this group. One thing I like about the fellowship, and partially because I helped figure out what would it have been, like what would I have wanted, is community. Right? You need other people who are doing jobs like yours, new businesses, innovation, entrepreneur. You need to be able to reach out and call and have that sort of group of friends that you can move forward with, because it is a hard job. It's a hard job internally. It's a hard job to get buy-in. It's a hard job because there's a lot of things that they're saying no to you for. But boy, the impact can be incredible. And it's just much easier to do when you have a group of like-minded people who are traveling this journey with you, as in anything. And so that's the thing I love about sort of thinking about this group coming together, for me as well, is how do we think about ourselves as a community that are supporting each other?
Totally. I want to thank everyone on the call. I'm going to hand it back to Paul to wrap it up.
Thank you, Mike, and thank you, Jeff. And we have lots more where this came from. We hope you can join us. We know that we have reached the end of the hour, and so we're going to declare victory and wish you the very good afternoon, good evening, good morning, and good day. Thank you.
Thank you, guys, very much.
Thank you.
Thank you very much.
Thank you.